Are you a filmmaker or content creator with a vision that demands the best? Then look no further than IPGRentals.com, the ultimate destination for audio, video, lighting, drones, and support gear for your productions. At IPG Rentals, we believe in the power of collaboration. Our gear becomes an extension of your creativity, bringing your vision to life. And with our tagline, Our Gear, Your Vision, we're not just a rental service, we're your production partner. Why choose IPG Rentals, you may ask? Easy. We bring quality, reliability, and an extensive range of top-notch equipment. From industry-standard cameras and audio equipment to state-of-the-art lighting and drones, our gear is meticulously maintained to ensure you get the best results every time. So what are you waiting for? Visit www.ipgrentals.com. Our Gear, Your Vision. Welcome back to Media Hub. Today we're diving into the topic that every creative needs, but few of us actually understand, the dreaded taxes. Whether you're freelancing as a camera op, producing gigs on the side, or running a production business, today's guest will help you figure out how to keep more of what you earn and avoid costly mistakes. Joining us on this episode of Media Hub is my personal tax guy, Lou Ciccarelli, a tax strategist and accountant who has been working with filmmakers, producers, and creators for over 30 years. He knows the ins and outs of write-offs, deductions, and all the hidden tax opportunities that most of us overlook. Let's listen in on what he has to say. So Lou, thank you for joining us today on Media Hub. Thank you for taking time out of your schedule and to doing us this favor. I know when I called you in the beginning, you were a little questionable, like, oh, I don't know, but I thank you for saying yes.
Yeah, no problem. No problem at all.
Listen, you have helped me. I mean, me and you go back. You have been my accountant now for over 12 years. I think I was going through all the tax returns. You have definitely seen my business grow. You have given me a lot of information and guided me and showed me, what to do and how to save, how to get the right deductions and things like that. So I just wanted to invite you on the show so we could share that knowledge with all our viewers. So in order to start, what we did is we came up with this new segment called Quick Takes. And basically what it is quick questions to let our viewers know a little bit more about you. So I'm going to throw some questions out to you, and then you just answer them as quick and as funny as possible.
All right.
Quick Takes.
All right, here we go. First question. What's the weirdest creative deduction you've seen someone try to write off? And please don't say it was me.
Oh, no, it wasn't you. I don't know if it was the weirdest, but they wanted to deduct $50,000 worth of meals and entertainment, and they only made $30,000 in income.
Oh.
So that was very, a red flag. So you could take reasonable.
And I know that term very well with you. You're like, Dondi, that's a red flag. We can't do that one. Because I love pushing it as much as I can until you tell me, nope, don't do it.
Yeah, I know. No, that, and we'll leave it at that.
Okay, next question. What industries do your clients work in? Like, I know you work in a lot of different arenas, just so people know, you don't just work in one sector, you work in many. What are some of the sectors you work in?
Yeah, it's a whole gamut of industries, from physicians, I have a lot of doctors, attorneys, construction people, freelancers, camera guys, and mainly some sports medicine people as well. So, some professional athletes. It's a really big mix, and I deal with a lot of corporate returns, estates, and partnerships. So it's the whole gamut.
What's one mistake you made with money before becoming a tax pro?
I think if someone would have drilled in my head to save for retirement at an early age, I would have. That's the one thing I wish I would have done a lot sooner, because it's all about compounding interest. Even if you just save just $50 a month, you're not going to miss it really. And in the end, you'll be a lot easier looking at retirement instead of trying to catch up later.
Quick takes.
All right, Lou, now let's get into the main questions of this interview. And the reason I wanted to bring you on too is when I first got in the industry, I made the mistake of going to like H&R Block or somebody like that. And I'm not putting them down, but how important is it to work with an accountant that knows our industry?
Yeah, I mean, look, they're a good company. They handle a lot of simple returns. I think when it comes to getting a little creative and looking for deductions with certain industries, I think it's better that you deal with an accountant directly. And then there's a lot of tax law changes. It's just difficult to keep up with. So it's definitely to your advantage to go to that route.
Okay, and I definitely agree with you. And that, when someone introduced me to an accountant that worked solely in TV and film production, it was a big difference. I didn't have to fight or try to tell them, hey, I could write this off, or I could write that off, or this should be a deduction. They already knew it. And they were actually telling me additional things that I could do. So that was a big plus. And I wanted to let people know, is like, you should definitely be working with an accountant that knows the television and film industry field. All right, here's the next question. If I just got my first freelance check, what's the very first thing I should do with it?
Well, if it's your first check, celebrate for 5 seconds, then treat it like a business. Open up an account, set aside some taxes, things like that. We'll walk through some of the setups with some other questions you may direct, because it's going to kind of overlap.
Yeah. So when you say that open up an account, do they or should they open up account in their name or a separate name, or let's say they're not a company. Let's say they're a sole proprietor, they're new in the industry, and they get their first check. Should they open up a separate account, name it something else personal, and keep it totally separate from their regular funds that they use for living?
Yes. If you're just getting started out and you don't know what direction you're going to take it, I definitely recommend setting up another personal account and use that account for just freelance work. It's going to be easier for you when it comes to time to do your taxes. You're separating your business income and business expenses with your personal expenses. So even though you're not an entity or you're just a sole proprietor and you don't want to open up a business account, open up a second personal account.
I've heard people say, save money for taxes, especially when you first get in industry. Make sure you save money for taxes. How much should people really save out of their checks?
Well, with freelancers, they don't have it's not like a regular job where they're getting taxes taken out. So it's up to them to set aside those funds for taxes. A good rule of thumb is, set aside at least 20% of that check that you're going to receive, even though you don't know what tax bracket you're going to be in yet, but to be safe, 20% is a general rule.
Okay. All right. Is it ever too early to start saving for retirement?
It's never too early to save for retirement. I really enforce that you start, right away, like take part of that check and invest it for retirement. Because look, again, it's all about compounding. Earnings grows on top of earnings, and that growth is going to explode. It's one of those things that, like as a freelancer, you're taking on a gig. It's that gig you can't cancel. You have to set aside for retirement.
Right, and it's very important, especially because like you said, compounding interest. A lot of people don't realize or understand what compound is, but it's about time. When you're young in your 20s, you're just getting in the industry, time is what's on your side, because you could actually put less away. It doesn't take as much money to put away for retirement, as if you say if you start in your mid 30s, 40s, then you have to almost double that. So time is basically on your side because of compound.
Yes. Even if it's just $50 a month, At 22, you compound that earnings on top of earnings, that's really going to grow. I mean, by the time you reach 65, you'll have a good chunk of change. I mean, if you got an average of 7% return on your investment, I mean, you could easily have from 500,000 to $1 million by then. So I definitely recommend it.
Yeah, because you gave a very reasonable number, $50 a month to start off. You think of somebody that's in, 20, anywhere from 23 to 25 when they're first getting out of college and starting their career, if they put that $50 away, and you don't tell me you can't afford it, because between probably getting coffee at Starbucks and eating out, that's easily one meal. Just by putting that away and compounding that for 30 years, like you said, that number you gave was pretty big.
Yeah, it's possible. I mean, look, you're not going to miss it. Once you get used to like $50, it's not really a lot of money in terms of where you are or where you're going to be. You have to start thinking of that, because as a freelancer, you are your own retirement plan. It's not like you have a pension or you have your work for an employer where you have a 401k. You have to incorporate some kind of retirement plan as a freelancer.
Where do you recommend for them to put the money, like in a Roth IRA or a SEP IRA? And if you could just tell us which one to pick, and just briefly tell us what's the difference between the two.
Yeah, I like the Roth IRA. And again, there's going to be like limitations of your income, how much, if you qualify for it. But most people, are going to it. There's income limits. But the Roth is great because you get to put that money in and it's earned tax-free. And whatever you earn for that period of time till retirement, when you pull it out, you're not going to pay any taxes on it. That's the big difference between a traditional IRA. Traditional IRA, yes, you get a tax deduction depending on your income bracket, but it's going to be earned tax-free. But when you retire to pull it out, you're going to have to pay the tax on that. I prefer the Roth, and that's a good start for a young freelancer just getting started to start contributing to a Roth.
And don't get me wrong, another big reason to do it ahead of time as well is because you don't know what the taxes are going to be in 20, 30 years from now, what that tax rate is, right? I'd rather do it ahead when it's most likely lower. Am I correct with that, or am I wrong?
Well, what happens is when you retire, hopefully you're not going to be working. Your income is going to drop. So you will lower your taxable income by, you're in a higher bracket. When you're working, you're making more money. When you retire, you're just going to drop down to that bracket. So you will have a lower bracket.
Okay. All right. Well, that's definitely good advice. How about this? Do I need an LLC even if I'm just starting out and doing small gigs?
No, you don't really need an LLC when you're just starting out. I think, the one thing that you're up against, though, is you're personally liable as a sole proprietor. The LLC gives you that liability protection. That's one drawback of not getting it. But if you're just starting out and the income is just gradually getting there, I would just be careful of, where you are. If you're taking on sets that are more riskier, then you may want to incorporate doing that LLC.
Okay. Here's an example, even for first timers, like a small gig. First of all, let me start off with this. On an LLC, is there a certain amount that you should make before even thinking about becoming a company?
A general rule is, if you're under 50, you make under 50,000, then you could just stay as a sole proprietor, or you could even do an LLC to show limited liability protection and to show presence that you actually have a company. But once you start inching your way past that mark, 50 to 100,000, then it's best that you start your LLC and then think about your tax structures. An LLC could still be a sole proprietor, but once you start getting up there, there's different tax structures.
Yeah. And I think one of the main things, too, is when you do decide to become an entity, make sure to talk to a tax accountant to do the correct structure. Like when I met you, I remember, I think I was a C corp, and you were telling me like, "Why are you a C corp? Like, you're paying like way too much in taxes. You need to change
Yeah,
this." And I think, and since then, I think we
yeah,
changed two times
yeah,
to take the most of the tax advantages, which people need to know. So
right.
one good key is for people to talk to a tax accountant or CPA or whatever, and make sure that they choose the correct entity for their business.
Yes. Yeah, you don't need to be a C corp for a freelancer. Those C corps are good for very large companies and want to raise investments. As a C corp, you're paying a lot of taxes. It's a flat 21%, but then you got Florida state tax now. Then you have to be careful when you pull money out. That's a dividend. Then you're getting taxed as a dividend. So really, you need to speak to an accountant as to what structure works best for what you're after.
Okay, all right. What's a super common mistake that you see people in our industry make with money?
Oh, the biggest one is
Yeah,
when they get that check, they spend it all. It's like they spend it. It's not a personal spending check. You have
right.
to treat it like a business. Separate, maybe look at it as buckets. Take your check and throw it in certain buckets: living expense, taxes, maybe some gear maintenance, or don't spend it all. That's what I see the biggest mistake people make.
Yeah, that's so true. Like if you look at my bank account, I think I have like 8 to 10 different accounts. I like you said, like your buckets. So you have your spending money,
Yeah,
your bill money, your tax money. Like that's the way I do it, just to make it. I
yeah,
need to make it
yeah,
as simple as possible for me. So now when I see
yeah.
that account, and if it's at zero or it's low, then I can't do it.
Exactly. That's why the good, I like to use the example as buckets because you know that you have so many buckets you want to kind of fill. But I see a lot of people, once they get a check, they like to spend it all on
Yeah.
personal items.
Right. All right. And you kind of touched on this next question, but see if you can maybe go a little further with it. But what's one money move that makes a huge difference over time?
The one money move that makes a big difference is to learn to pay yourself a paycheck. Not theoretically a paycheck, but you have your first check or your checks that you're coming in for freelancer. Set aside, obviously the money for taxes, but pay yourself. That's the big move that you can make that will be helpful.
Is there a certain percentage of that check that they should take out? Because as freelancers, all our checks could always be different, right? As
Yeah,
a freelancer. So is there a certain
right.
percentage so people know, hey, I got to take out 10%, 15%, 5%? What should that percentage be?
I think it's going to depend on your financial needs and how you want to live your life and what's financially you need to get by. But I would just set aside like 10%. Just really sock it away. It's really going to make a big difference. Is that you have to allocate a portion for yourself.
Is it, do you think that they should put that money away in a separate account, not tied to that, maybe that bank or maybe a high yield savings account or something like that?
Yes, I would. This way, that you're contributing to some kind of savings. You really need to set aside emergency savings. You never know. Yeah, it's nice. That's what paying yourself represents. I mean, besides the retirement fund, this is something that you could set aside for yourself for, investments and down payment on a house or emergency funds.
Okay, all right. What are some common deductions people in our industry can do?
The main one is like gear. If you purchase a camera, any kind of computer equipment, you get big write-offs for that. Obviously your travel expenses, mileage on your car. If there's liability, kind of insurance you may pay. Cell phone, internet. You have your home office. So those are basically the general deductions. Sometimes a lot of people do researches on cable research or, periodicals that they're reviewing, so there's a lot of that too.
I'm glad you brought that up because I was gonna ask you about subscriptions, right? Because there are subscription bases out there that people use for research or to learn more about their industry or things like that, and some of them forget as, hey, you can write that off as long as you can prove that it's for your part of your business.
Yeah. Obviously, there's going to be some personal use, but we can allocate a portion to business. But yes, subscriptions, dues. If there's union dues, there's a whole gamut of supplies. Batteries, things like that.
Okay, what if they have a home office?
Yeah, you can deduct a part of your home as an expense. Now, there's some changes. You could do like a reimbursed expense they came up with, but you could take a percentage of your square footage of your house and say this is for your business. So yeah, you can write off expenses for your home.
And this would work perfect. Like I'm going to use me for example. When I first started, I had a certain room set aside with a computer desk. Like it was literally a home office, but I also had all my equipment in there. And everything was to the side. It was totally separate from the house. And then I believe I came to you and I said back then with cable, electricity, utilities, like you could write a percentage of all of that off. Am I correct with that?
Yes, that's correct. So they take a square footage of the office space, referencing the total square footage of your house, and you can take actually a percentage of the mortgage interest, real estate taxes, utilities, the internet. So yeah, you could come up with a good deduction.
Okay, I'm going to throw a little twist in here because this would mostly go for 1099 subcontractors, correct?
Yes, there used to be employees could do it too, but not anymore.
That was my next question. Okay, so employees, W-2, if you take a W-2, then you cannot write those off.
Yeah, the employee business expenses got nixed. They deleted that. No more. You can't take them anymore. But as a independent contractor, freelancer, you can take those expenses.
Okay, which brings me to another question. In most of your clients as well, because I know a lot of your clients, right? Yep. A lot of them work with certain companies that they get paid as a W-2. But they're really freelancers. They're really subcontractors. None of those write-offs pertain to them?
No, that's not correct. They still will be able to take those deductions because, well, most of them have both. The employees portion, they get a W-2, and then the other portion, they get a 1099. The 1099 portion, they can take those deductions, not the W-2 side of it.
Okay, so if they were, I'm going to give you a scenario. If they were working for a company that there's a freelance to, but they only get paid as a W-2 employee, as a check through W-2, so they take out the taxes, and at the end of the year they get a W-2, can those people still write off a percentage of everything we talked about?
No.
Wow.
Yeah.
That sucks.
Yeah. They won't be able to do it.
They literally lost out.
Yeah, that's the advantage of being a business owner or a freelancer. You're really flexible with your expenses. But yeah, they don't allow employee business expenses anymore. So if you're just strictly W-2, you're out.
Okay, so that means that you would have to mix in, like, when you do my taxes, I got like maybe 5 W-2s, but I have like 40 1099s. They would need a certain portion of 1099s to be mixed in there. Is there a specific amount that you need?
No.
Okay.
No. So let's say they do 5 W-2, gigs, and then they have like 2 or 3 1099s. Then they're open. It's flexible with them. They can deduct those expenses, even though they maybe not showing a ton of income, but it's going to be reasonable.
Okay. Here's another important question, because whenever you're filling out those I-9 forms, and it gets to the part where you're saying, well, how much are you claiming? You know, the simple answer for me was always zero, take out the most so it could help me with my 1099s. But what do you recommend for people to put in that certain section of the I-9?
Well, if you're talking about W-2, then it will be, the form is called the W-4 form.
Okay.
Not an I-9. That's for the 1099. So I know they changed the form a lot. They used to be able to claim things or go exempt. You can still go exempt, but it's best to just fill out your marital status and single or married filing jointly, and hopefully they'll follow the charts correctly, the payroll charts. It just gets a little complicated to calculate it for various jobs. Like you may have 2 or 3 jobs and you might not want to withhold stuff. Then you have to fill out a certain line item in there that you'll have to complete.
Okay. All right. How do you keep good records throughout the year? How would you recommend for people to do that?
Yeah, you're just starting out, and you could look at Google Sheets, or spreadsheets. That's kind of good. There's QuickBooks for self-employed, or there's app. There's a app called Wave that tracks your accounting. I like the app Mile IQ. It's a mileage tracker. It's based on a GPS. It tracks all your trips. You don't have to log anything in. I like that app. But spreadsheets usually are simpler to use, and you don't really need any kind of sophisticated software initially, unless you're invoicing clients. Then you might want to look into QuickBooks or the app Wave. Okay.
What's the worst way for someone to come to you at the end of the year and be like, here's all my stuff for you to do my taxes? What is the absolute worst way for someone to come to you and say, here's all my stuff?
The worst way is when somebody brings me a shoebox full of receipts and bank statements, and they say, I don't know what I did. Please help me. And I look at them like, this is, you have to know where you're at. If you're going to start your own business, you need to know how much money you make, where you're at. And that's the spreadsheet. I do provide a spreadsheet where you could do monthly, where you are, what are your expenses. This way you gauge, you need the budget. You need to know where you're at, so you want to grow your business. That's definitely better to have some kind of reference of where you're going, how you're growing.
Absolutely, which as you grow, you definitely need to start keeping good records of everything so you can see what you're making. I remember when I first got QuickBooks and I really saw how much money I had floating out there waiting for checks to come in, because as a freelancer in the beginning, you're like, oh yeah, I'm waiting on this check and this check and this check. But you really don't know until you see it in front of you. And when I first got started with QuickBooks, like in, 2007, maybe 2008, I was flabbergasted how much money I was floating out there every month. So, it's definitely a good way to start keeping track of everything. All right, here we go. This is for someone that's maybe a little bit more seasoned now, and they're looking to move up or become a business. Now they're making more money, and they need to become an entity. You tell me, what's the best way, or what should they choose? Go from Sole Proprietor, LLC, S-Corp, C-Corp, and just tell me a little bit about each one so they could have an idea of what to choose for them.
Yeah, so an entity structure, you're automatically, as a freelancer, when you're first coming out, you default to a sole proprietor, which is good initially. You get started, you earn your certain amount of money, but you're limited to the protection, liability protection, and you're up against self-employment tax, which is like an extra 15% that normally you're subject to 2 levels of taxation. One is the income tax, which everybody pays, but now you have to pay an additional self-employment tax, which is that 15%. If you were working for somebody, your employer will cover that, but now you have to cover it. As you go along, you could, as you grow, you want to be more established and have a presence, an LLC to get started. Same thing, it's going to flow through as a sole proprietor. You file 1 tax return. But you take it to the next level where you be taxed as an S-Corp. This way, you're going to limit that self-employment tax. You'll have to set up payroll, but you're limiting that extra 15%. You're cutting that in half. So that's where you want to go. You want to go from an LLC tax to as an S-Corp.
Okay. And what about the C-Corp? What would you say about that?
Very rarely do you see a freelancer do a C-Corp. It's not worth it. There's too many taxes. You got to pay income tax, Florida state income tax. Then if you pull money out, that's a dividend tax. You still got to do payroll. I don't recommend it unless you want to start a large company where you're going to get a bunch of investors and you're going to take it maybe to an even higher level than the S-Corp. Mm-hmm. But that's really geared towards more trying to get investors.
Okay. So as someone that's making, let's say, $75,000, which entity direction would you push them on, between an S-Corp or an LLC? I'm assuming it'd be one of those.
Yeah. I look at this. If they're grossing $100,000 and they got, I don't know, $20,000 of expenses, they're netting $80,000, then I tell them to make a switch from an LLC tax as a sole proprietor to be an LLC as an S-Corp. You'll save around, depending, $3,000, $4,000 a year in taxes when you do something like that. It's a game you're playing. You're just segregating some of your income away from that self-employment tax, which is that 15.3%.
Yeah. And I'm going to bring up the issue that I had just a couple of years ago, and you're like, Dondi, why are we doing this? And it's a catch-22 with people in our industry, like with me, a freelancer, subcontractor, my own business. And most of the time I always ask companies, hey, can you pay me through the company? And I always call you ahead of time, right? I'm pretty good about calling you with this. But I was running into an issue with the production company in Georgia, a reality show. I said, hey, I want to get paid through the company. It was like a 4-month job. And they said, they can't pay me because you're an LLC. And you needed to be an S-Corp. Remember this, Lou? And we had to change the structure, right? And I was like, Lou, hey, I'm losing quite a bit of jobs because they're not paying me because I have to be an S-Corp, and we wanted to change. And you were against it. Explain why you were against it, so people, because I know I'm not the only one dealing with this. Explain why it was bad, but I ended up choosing to do it anyway to keep the clients.
Yeah, I think I recall that they were trying to push off they were entitled to some kind of credits, and so they were kind of pushing you away from those credits. Yep. And they were mainly looking at being the entity was a sub-S corporation. Mm-hmm. The entity you had was I think it was a partnership. The LLC tax is a partnership, so it was still a good way to go. It's just that their requirement with your industry, sometimes you hit a spot where people you work with prefer that type of entity. So either way, I think when it's just a sole person, then you definitely want to go towards the LLC tax as an S-Corp for the best advantages and for your industry.
Okay. Now, was I getting more of a write-off as the partnership, as a write-off of tax deductions, or what? How did it work? I don't remember.
No, you got the same write-offs, exactly the same.
Okay.
The only difference was we didn't have to do payroll because as a LLC tax as a partnership, I set up a guaranteed payment. Yep. That I could put on the tax return. Whereas if you go to LLC taxes and S-Corp, now you have to do a salary. You have to do your own payroll, and then you got to do the payroll returns and records. So that's the difference. That's why the LLC tax as a partnership was just you and another partner and made it easier. But certain industries require the S-Corp, and that's why we made the switch for you.
Okay. And how would somebody know when it's time to switch from one entity to another? Or is that what it would be called, an entity? Because it would be LLC, partnership, S-Corp. What is that called?
It's called the tax structure.
Okay.
You are an entity. LLC is an entity. now you're automatically taxed as a sole proprietor, which again, that's double taxes on the self-employment tax. Being a LLC tax as an S-Corp, you're going to save maybe half of that on payroll taxes. The good change is it's worth it when you're making, like I said, 100,000 and you're netting 80,000. Then it's cost efficient to make the switch because there's another return you have to do. You have to do a separate business return that passes through to your individual return. So you have two tax returns. If you don't make, if you're not in that income range, better off staying as a sole proprietor. Is just one tax return. It'll cost you a little bit more, but the cost benefits there don't really outweigh because you got to pay the accountant to do another tax return. So best to stay, depending on how your growth goes, best to stay as a sole proprietor, LLC, or when you're ready to make a switch.
Okay. All right. That's very good advice. So Lou, if you're paying yourself from your business, how does the business structure affect you? And I'm going to use me an example here. For a long time, I was just taking distribution payments. And you can't even be like, Don, you got to start paying yourself. You're taking a lot of distributions and we're causing a red flag. Explain that.
Yeah. So when you have an LLC taxed as an S corporation, the IRS is requesting that the officers take a reasonable salary. When they first started these S corps, everybody jumped on board because they eliminated the self-employment tax. They got away from that 15%. Well, now the IRS is saying, we want you to take a reasonable salary. So you cannot take, you could, but I wouldn't recommend you take 100% of distribution out of your company because you could get audited. So they just recommend, they don't say how much your salary is, but they have certain percentage that they want you to take. So they're looking at maybe 60-40 split, but they want you to take a reasonable salary. They just don't like to see you take all the distributions out. So you could do payroll. That's the way to do it. Set yourself up on payroll taxes. But then there's a beauty of that is you could start your own 401k plan. So you defer your taxes even more, but still get the salary deduction.
What are the pros for opening up that 401k for yourself?
Well, they have this one that's for small businesses that it doesn't cost anything as long as your 401k assets stay below 250,000. Then usually the brokers will set it up for free. So when you do your payroll, you're gonna defer some of your salary to 401k, but you still get the full salary as a deduction. So, and then you're meeting the requirements of a reasonable salary, but even though you're deferring it, but you're just paying that extra, some of it on the self-employment tax that sole proprietors get dinged a lot with. But we're just trying to balance that out to save money in taxes. So you could save $3,000 to $4,000 a year in taxes on self-employment. That adds up over the years.
Yeah. You just, my head is running now. Now I'm thinking. So you're saying if I put money in my 401k, I take a certain deduction from that towards my payroll, plus I'm making interest on my money for 401k, considering as a retirement as well. Am I correct with that?
Yeah. So you could you have an LLC, taxed as an S corp. If you're a sole owner, you can still start your own 401k. You can even do what's called a Roth 401k. Or if you want to do the traditional 401k, you have, let's say, a $50,000 salary, you could defer some of that, whatever you want to put in your retirement account. Then on top of that, you're allowed to take up another 25% of profit sharing. So you could really sock away for retirement.
Man, we have to have a meeting, me and you, because that was part of the questions that I was talking to you about earlier. But me and you are going to have lunch for sure.
Okay.
All right. Quarterly taxes, the dreaded quarterly taxes that everybody hates paying, including myself. And I didn't even start paying quarterly taxes till the business was probably over 10 years. What's the estimated quarterly taxes? How do we figure that out, right? And why are they important to pay?
Yeah, nobody likes paying the quarterly taxes. I know, I don't either, but you have to. So the IRS wants you to send in an estimated tax as a freelancer. They want you to pay in at least 90% of your taxes. And that's why they set up these quarterly things. Every quarter you have to send it in. So if you owe, even if you owe over $1,000, you are you're set up. You have to set up to be quarterly taxes. That's the requirement, because if you don't pay in those quarterlies, what happens is they're going to penalize you for not paying in the minimum required amount that you're supposed to pay in. So they ding you for that. So that's why I always stress to clients, listen, try to pay to avoid penalties, because they ding you heavy with penalties if you don't make them.
Okay. When should there be a specific amount that they're making before they start doing quarterlies, or it doesn't matter?
It depends on the income. It depends on the net income they make. That's why when you're first starting out, you set aside 20%. You're going to have deductions. So the first year is always an estimate. They don't ding you in the first year. It's just the second year that you're finally set up. They know you're a freelancer. Now you got to make that requirement of 90% of your taxes at least, so that you don't get penalized. So there's not really a certain percentage, because everybody's different. Everybody has their different income tax bracket. So it all depends on your tax liability. And you won't know until the first year. But when you first start out, at least do 20% and send in that, just to be safe. And then once you're set up, then we'll automatically set you up on quarterlies.
Okay. All right. Why would you say a CPA or a tax advisor is worth the investment?
Yeah, I think that it's best to approach a good accountant, tax accountant, or CPA, because look, the tax laws change, and there's so many complex laws and updates that it's so difficult for you as a freelancer to keep track of everything. So that's why it's great to have somebody, on watching your back with these new changes that could affect your industries. Now that the new bill that just came out, there's a lot of changes with tips, and so there's certain nuances that the accountant really can hone in on for your industry.
Okay, that brings up a great question, and we'll end it with this. But the big, beautiful bill, the new bill that just came out, how does that help people in our industry?
Well, there's going to be some changes from tax structure, but I don't see any big changes for your industry, other than the biggest one is going to be equipment. You can get to write off a lot of equipment. It's 100%. They made some changes now with that, SUVs, vehicles. It's good. That would affect you a lot. But the other focus is, in a different industry. So it's going to affect some industries, but not all of it. But generally, yes.
Okay. I'm going to throw two things at you. You said equipment, and you said writing 100% off, right? Now, you're saying that they could write off 100% that year, so it's not over depreciation. It's that year.
Yeah, so it's called Section 179 deduction, meaning that you have a piece of equipment, you get to write it off 100%. Now, in the past, they limited it to 80%, but this new bill is supposed to do the 100%. So yeah, the bad part of that is that you don't have a write-off the following year. So, equipment usually gets depreciated over a 5-year period, but with the Section 179 deduction, you could take it in immediate deduction. Also, there's other deductions in your industry and everybody's industry, is that Section 199 deduction, domestic production. You can deduct that. You're not limited to that. Certain industries are.
Okay. And the other good point I wanted to bring up is vehicles. Because I was doing some research. I literally called you the other day and I said, hey, Lou, I heard that any vehicle that's over 6,000 pounds, we could either write off 100% or we get, was it 33,000, 35,000?
write off that year?
Yeah. Yeah, so it's been around, but they extended the 100% deduction. So if you buy a vehicle where the gross weight is over 6,000 pounds, then they will allow you to write that off 100% in that given year of purchase. Or you could space it out over a 5-year period. And then your first deduction will be, year deduction will be 33,000 with a bonus depreciation. So it all depends on the weight of the vehicle.
Man, when I read that, I called you right away. I'm like, Lou, is this legit? Because we need a vehicle like right now, like we really do. One of our vehicles is reaching that age and we're looking for a new one. And I was like, man, this is going to work great. And for me, I'll use it like this year. We'll need the tax deduction.
Yeah, I know. But the bad thing is that you get the deduction at first all in one shot, but then you don't have anything the following year. So.
You know me. I always have stuff I'm calling you with. Lou, I got this.
I know. You're always buying stuff.
Well, Lou, hey, I want to thank you for your time. Thank you for all the wisdom that you've said today. Hopefully you would like to come back, especially we have a lot of comments below. We'd like to invite you back on another episode. But in the meantime, if someone would like to reach out to you, what's the best way for them to contact you?
The best way to reach me is my email address. You can direct any questions. I'd be happy to answer people getting started. So feel free to reach out.
Awesome, Lou. Well, thanks again, man. Until next time. And remember, I owe you a lunch.
Yeah, no problem. Take care, buddy.
That was pure gold. Taxes might not be sexy, but not losing your money absolutely is. Big thanks to Lou for breaking it down and helping us get smarter with our finances. If you're watching this and freelancing or running any kind of creative hustle, this is your wake-up call. Get your money game in order. The IRS doesn't care that you were on set for 18 hours. They just want their paperwork and their money. So be sure to follow, subscribe, and share this episode with any creative in your life who keeps their receipts in a shoebox. We'll catch you on the next time on Media Hub.
Are you a filmmaker or content creator with a vision that demands the best? Then look no further than IPGRentals.com, the ultimate destination for audio, video, lighting, drones, and support gear for your productions. At IPG Rentals, we believe in the power of collaboration. Our gear becomes an extension of your creativity, bringing your vision to life. And with our tagline, Our Gear, Your Vision, we're not just a rental service, we're your production partner. Why choose IPG Rentals, you may ask? Easy. We bring quality, reliability, and an extensive range of top-notch equipment. From industry-standard cameras and audio equipment to state-of-the-art lighting and drones, our gear is meticulously maintained to ensure you get the best results every time. So what are you waiting for? Visit www.ipgrentals.com. Our gear, your vision.